Welcome to today's video, where we explore the high-stakes risks of mixing family and finance through a real-world scenario. To set the stage, we will walk through the emotional, legal, and financial complexities of lending a large sum to a relative, and we will contrast it with simpler, safer alternatives for generating reliable income. As we proceed, we will use diagrams, quizzes, and practical steps to help you make informed decisions. Let's begin. First, we will outline the scenario. Next, we will explain why this deal is not an investment in the traditional sense. Then, we will unpack the international legal complexity and currency risks. After that, we will compare simple versus complex strategies. Moving forward, we will present a safer, step-by-step approach to building reliable income. Finally, we will wrap up with key takeaways, a summary, and a couple of short quizzes to reinforce your understanding. To start, consider a wealthy individual contemplating a $1.6 million loan to a relative for refinancing a high-value villa overseas. The deal is marketed as low risk, with a 4% return and monthly cash flow, secured by foreign real estate. However, even though this sounds structured and attractive, we must look deeper at the relationship risks, legal hurdles, and concentration exposure. With that context, let's examine why this is not an investment in the conventional sense. Now let's address why this is not an investment. It is primarily a relationship risk before it is a financial decision. The cardinal rule is that if you lend money to family, you must be prepared for it to become a gift if repayment does not happen. This scenario creates a single counterparty risk with highly concentrated exposure. Emotional decision-making often replaces disciplined risk controls, and if enforcement becomes necessary, the relationship may be permanently damaged. With that foundation, let's visualize the risk landscape to make it more tangible. To visualize the problem, this mind map places the family loan at the center and branches into 4 risk categories: relationship, legal, financial, and currency and tax. Relationship risk includes the strain caused by late or missed payments, and the reality that a loan may effectively become a gift. Legal risk involves enforcing a lien in a foreign jurisdiction and the complexity of cross-border foreclosure. Financial risk centers on concentration and the loss of liquidity in a large, illiquid loan. Currency and tax risk includes foreign exchange volatility and the intricacies of cross-border taxes. With that structure in mind, let's move to a decision pathway. This decision tree starts at a simple but critical question. Are you willing and able to lose both the money and the relationship? If the answer is no, the pathway points to do not lend. If yes, the next checkpoint asks whether you have independent legal and tax counsel in the borrower's country. If not, do not lend. If yes, the next branch evaluates whether you can perfect a lend and realistically enforce foreclosure in that jurisdiction. If that cannot be assured, do not lend. If it can, the tree then asks whether you can tolerate currency volatility and potentially years of litigation. If not, do not lend. Only if all criteria are met, and the loan remains a small portion of liquid net worth with fully documented contracts, does the path suggest proceeding. With the framework clear, let's dive deeper into the legal terrain. When a loan is secured by foreign property, the legal complexity increases dramatically. Securing a lien may require specialized legal counsel in the relevant country. Enforcing a foreclosure can take years and becomes expensive very quickly. Foreign exchange risk, such as volatility between the US dollar and the euro, can reduce or eliminate the effective return, regardless of a 4% nominal rate. Cross-border tax reporting and withholding can further complicate cash flow. Jurisdictional disputes magnify uncertainty and raise the overall stress of managing the arrangement. Given those issues, let's compare complex arrangements with simpler, time-tested approaches. On the left, a simple strategy uses low-cost, diversified index funds across stocks and bonds. It provides liquidity, transparent pricing, and broad diversification that mitigates single counterparty risk. Set and forget rebalancing and a disciplined withdrawal plan make it operationally light and historically robust for long-term objectives. On the right, a complex private loan to family concentrates risk in a single borrower, introduces illiquidity, and layers on legal and currency complications. It demands constant monitoring and can produce catastrophic losses if things go wrong. To illustrate concentration, let's look at it as a pie chart. This pie chart displays half of the liquid portfolio allocated to a family loan and the other half to all remaining assets. The visualization makes it clear that a single position consumes a disproportionate share of the portfolio, increasing risk and reducing flexibility. If that single position deteriorates or becomes illiquid, the entire financial plan can be jeopardized. Now, to balance perspective, let's review alternatives for conservative income. This table outlines several conservative income options. High-yield savings or certificates of deposit have low risk, high liquidity, and low fees, though rates vary and deposit insurance limits apply. A treasury ladder is low risk, with high liquidity and very low fees, while allowing maturities to be matched to cash needs. Investment-grade bond funds carry low to moderate risk, maintain high liquidity, and have low fees, with net asset values fluctuating due to interest rates and credit conditions. Dividend-focused exchange-traded funds present moderate risk with high liquidity and low fees, but dividends are not guaranteed. Finally, a broad market index paired with a disciplined withdrawal plan offers a diversified growth engine with high liquidity and very low fees, recognizing that sequence of returns risk should be managed with a cash or short-duration bond buffer. Next, we will provide a practical path to build a safer plan. Here is a safer path to steady income. First, define annual spending needs and build a 3 to 5 year cash cushion. Second, construct a treasury or certificate of deposit ladder to fund near-term withdrawals. Third, use low-cost global stock and bond index funds to provide growth and diversification. Fourth, set a target asset allocation and automate rebalancing. Fifth, implement a conservative withdrawal rule with guardrails. Sixth, keep any private loans to a small percentage of liquid net worth, for example under 5 to 10%. Seventh, if assisting family, consider gifts you can afford or encourage professional financing options rather than becoming the lender. Eighth, always consult independent legal and tax advisors before any cross-border commitments. With these steps in hand, let's quickly review a red flags checklist. Watch for these red flags. 1. A large share of liquid net worth is at risk, perhaps around half. 2. Repayment depends on a single person or a single property. 3. The collateral is foreign and licit enforcement is unclear. 4. There is a currency mismatch between your income and expenses. 5. There is pressure to decide quickly or to skip independent counsel. 6. There is no clear exit plan or secondary market to sell the loan. With that, let's test your understanding with a brief quiz. Question: what is the cardinal rule when lending to friends or family? Options: A. Always charge the highest rate you can. B. Be prepared for it to be a gift if it goes unpaid. C. Only lend if collateral is foreign real estate. D. Never document the loan. Trust replaces contracts. You may pause the video now to think about the answer. We will discuss the answer in the next section of the video. The correct answer is B. Be prepared for it to be a gift if it goes unpaid. This mindset helps protect both your relationship and your financial plan. If you cannot afford to treat the amount as a gift, you should not make the loan. Question: which additional risks are introduced by securing a loan with foreign property? Options: A. Complex licit perfection and enforcement. B. Currency fluctuations affecting returns. C. Cross-border tax and reporting complexity. D. All of the above. You may pause the video now to think about the answer. We will discuss the answer in the next section of the video. The correct answer is D. All of the above. Foreign collateral adds legal complexity around licits and enforcement, exposes you to foreign exchange volatility that can reduce returns, and introduces cross-border tax and reporting challenges. This video is for educational purposes only and does not constitute legal, tax, or investment advice. You should consult qualified professionals who understand your circumstances, especially before pursuing any cross-border lending or complex financial arrangements. Here are the key takeaways. Family loans are relationship risks before they are financial decisions. If you cannot afford to treat the amount as a gift, do not lend. Foreign collateral adds significant legal, currency, and tax complexity. Simpler, diversified, and liquid approaches frequently outperform complex schemes in terms of reliability and manageability. Conservative income plans typically rely on low-cost funds, cash buffers, and bond or certificate ladders. In summary, concentration and cross-border risks can undermine deals that are presented as low risk, particularly when family is involved. A disciplined, diversified approach reduces stress and helps preserve relationships. If you would not be comfortable losing the money and dealing with enforcement costs, the prudent choice is to walk away. To close us out, here is one more visual reminder. Thank you for watching. If you found this valuable, please like, share, and subscribe for more content on practical investing and risk management. I would love to hear your thoughts and experiences in the comments.